Okay, so let's go ahead and start to take a look at our first slide and distinguishing our auditing class from other accounting classes that you have taken. In your introductory accounting course, you're just learning the basics. But when you start getting an intermediate, you are really looking at rules, procedures for preparing financial statements. You're following the rules of the Financial Accounting Standards Board. FASB is most of what you learn, but also, of course, you learned a little bit about international accounting standards promulgated by the International Accounting Standards Board, the IFRS standards, International Financial Reporting Standards, but rules and principles that are used to prepare financial statements. When we talk about auditing, we are going to, of course, have standards that we're going to look at, guidance that we're going to be looking at, but it is really directing the auditor as to how you will take evidence, analyze that evidence, corroborate that evidence to then draw your conclusions about the financial statements. For some more of a conceptual, how does the auditor apply the standards, the procedures to allow us to be able to get assurances or provide assurances and allow us to add credibility to the financial statements. And remember, I said in some of our introductory comments, it's important that as we go through and understand more about these procedures, that you're able to visualize yourself actually physically doing some of these things, and that auditing is a living, breathing practice that that we're going to want to start to get comfortable with actually visualizing ourselves doing some of these procedures. I often tell my classes, if you don't know why you're doing an audit procedure, then you're not doing your job. So it is not just a mundane doing of procedures just for the sake of doing them. We're trying to allow those procedures, following those procedures, so that we are able to obtain the evidence to determine whether or not the financial statements are fairly stated. So we have seen growth in the auditing profession, and they're saying over the last 200 years here. 200 years might be a bit exaggerated in that the accounting auditing profession has been around for 200 years. If you see the movie A Christmas Carol, I like the cartoon versions of those, but if you look at Scrooge's firm, it was essentially a CPA firm back in those times. Poor Bob Cratchit working long hours, that was a CPA firm. But the real growth in the profession, in my opinion, is coming from the stock market crash of 1929, and you have the securities laws 33-34, which added the requirements that there be the CPA profession come in and do work to provide credibility to the financial reports, because a lot of what was believed that caused some of the stock market crash was problems with the reliability in financial reporting. Now, when we're talking about this, and you look at all these graphics here, obviously they're focusing on public companies, showing us Wall Street, and I guess this is a ticker tape over here, showing us all this stuff. But non-public companies can also use auditors to provide, and a key word here, to provide assurances. Okay, so when we take a look at what we were really talking about earlier, the separation between the ownership of the company and the management of the company. And when we talk about the management of the company, we can talk about the managers as being the agents and the stockholders being the principal, just to use analogous terms that you may have seen in some of your other studies. And when I look at agent and principal, I think the agent as being Jerry Maguire, and Tom Cruise played the character in the movie Jerry Maguire. That's the agent. The principal is the player, is Cuba Gooding Jr., whatever that player's name was in that movie. And so that relationship exists between the managers and the stockholders. And the stockholders are really the owners. And of course, in public companies, we have a huge separation between the ownership of the company and, of course, the management of the company. And so you can see, going over to the next slide, we have this idea of our absentee owner being the principal, and the management being the agent. And the auditor provides that go-between, if you will, here by looking at evidence. And evidence, guys, is going to be a key word. Evidence is what we are going to look at to give us an objective opinion as to whether or not the financial statements are fairly stated in accordance with whatever the applicable framework is, U.S. GAAP, etc. And so that auditor provides us that comfort level. Remember in our little example here at the beginning, when you were out of the country, you were an absentee manager, and you were looking for the auditor to come in. Remember that brain came in and provided credibility to the financial statements. Now when we look, we can see that the principal, the owners actually hire the auditor. So the owners are going to be the ones that hire the auditor, and then they're going to go ahead and report on that fairness. Now you say, well, how the heck can the owners, we have thousands of stockholders, what are all those thousand stockholders going to come and interview the auditor? No, we look to the board of directors to do that. So board of directors are the ones that hire the auditor, make sure that the auditor by contract is paid the appropriate amounts, etc., so that there's still that separation between the hiring of the auditor and the actual management of the company. We look to the board of directors to provide that function of hiring, overseeing the auditors. And they typically have a committee called the audit committee that provides that function at the board of directors level. And we'll talk more about that when we get into some of the later chapters talking about client acceptance. Now, when we look at financial statements, and guys, this is a very important slide. I'm going to suggest that you go ahead somewhere and put a star on this slide, okay, so that you're remembering this one. I guess that's a star. And it's pretty important that you remember this slide, because when we look at financial statements, we no longer look at them as just a bunch of numbers sitting in a bunch of accounts. Yes, I know that you learned that in accounting, but as auditors, we look at financial statements as assertions. Okay, these are assertions made by management. Management asserts to us that if we have, let's say, an asset, that that asset actually exists. So if management puts down equipment on the financial statements, okay, they are asserting to us that we should be able to see that equipment on the financial statements and then walk out and actually find that piece of equipment that we see sitting on the financial statements. Okay, so these are assertions. That's how we look at these financial statements, because we're going to gather, again, another one of our key words, evidence, to support that that asset actually exists. And if we go out and look at that asset, then our evidence is our direct personal knowledge, because we went and looked at that asset. Now, just because we see the asset, does that mean that management owns the asset? No. They might have gone to Rent-A-Center the night before and rented that asset. So it doesn't mean that they actually own that. So if they're putting that down as an asset that they own, we might like to see a deed or a something showing that they purchased that asset, an invoice, something like that, to support now the rights assertion, to assume that they actually own that asset. Now this is why this slide's so important. When we go through and we start getting into some of the middle chapters where we start talking about how do you audit revenue, how do you audit expenses, how do you audit assets like property, plant, and equipment, it's going to sound to you like we're talking to you about these procedures, these steps, and you're going to be tempted to say, well, I just memorized, I don't really know what I'm doing, but I'm going to memorize these procedures. I'm going to keep pushing you to look back that you're actually auditing an assertion. And if you know how to audit an assertion, then you can apply that knowledge of how to audit the assertion to any one of these accounts. And this starts to really strengthen your understanding of auditing. So assertions, very, very important. They have put them in different categories, and you can see the three categories here as you go through and look at this. And let's just take a look at these categories over here, and you can see that we have transactions. Okay, when you think of the category of transactions, think of your journals, your sales journal. These are transactions that happen in this current year. Okay, so it's the period under audit. When we think of transactions, it's the period under audit, it's the current year. Sales are reported by year, so we're talking about things that go into our journals like our sales journal. When we talk about assertions related to account balances, think of that as our ledgers. So it doesn't matter if we purchased an asset 2 years ago. If management says that it still exists, then we're going to want to get evidence to see that that asset exists, even though it may have been purchased, say 2 years ago in our example. Okay, when we talk about presentation and disclosure, I want you to think of footnotes. For example, are all disclosures that should have been included in the financial statements been included? And disclosures really talks about footnotes. Now, if you look, you can see that not every assertion appears in every category, but several of the assertions are repeated in the different categories. Only cutoff appears in the transaction category, because again, that's relating to things being included in the proper year in the proper journal. So if you look at that one category here, you can see that the transaction category, you can see that there are 6 assertions, and that's the maximum number of assertions. There's 6 total that you see here, and then you just see that some of these repeat throughout. Now we're going to talk about these some more, but right now I think it's probably a good idea if you memorize the category of assertions and memorize what they are, and as we go through, guys, I promise you're going to get better and better at understanding how you audit these assertions, and that's going to be a major takeaway from this course. Okay, taking a look at the next slide now, looking at our different levels of assurances. Okay, so we have our assurance services, and assurances encompass both attests and audits. Okay, so let's just take a look and just think of some examples underneath these. When we talk about auditing, auditing is an assurance service, as you saw in the previous slide, and that's typically providing an audit, providing an opinion over financial statements. But auditors now, and the classic one now comes from the Sarbanes-Oxley Act 2002, that for public companies, auditors are to attest as to the ability of the internal controls of the company to provide reliability in financial reporting. So they look at the effectiveness of those internal controls in determining, in helping the company to assure reliability in their financial reporting. So since it's not giving an assurance on the financial statements, we tend to list those as an example as attestation. Okay, so what happens? Both attestation and auditing are assurances. An audit is considered an attest, and that you are testifying to the financial statements as to their fair presentation. So you're testifying as to that. But if you give an assurance on something other than the financial statements, we don't call that an audit. We just call that an attest. So audit is an attest. But not all attests or audits, because again, we could attest to things other than the financial statements, and both of these are considered assurance services. So you take a look, and again, we have this separation between the ownership and the management. And so what happens, and I like to look at this slide, I would recommend looking at it more down than across. I know they've given us some across there, but I don't care for the across so much. I like more the down part of it. Okay, and let's just consider how this works, thinking of from the down standpoint. So what happens? Management, of course, is the one that's going to be responsible for the financial statements. And remember, we asked as our discussion question the responsibilities of management, the responsibility of the auditor. Management is responsible for financial statements. Okay, now what they do, you see the financial statements are way down here, but what's going to happen? They are also responsible for establishing those internal controls, and those internal controls now will help prevent, detect misstatement in the financial statements, misstatement with the accounting standards, misstatement in the assertions. Let's remember assertions. So what happens? There should be internal controls so that management doesn't, and I'm going to put, you can't see me right now, but I'm going to put quotes, picture me doing quotes in the air right now. Management accidentally includes an asset on the financial statements that does not actually exist. And the reason I'm doing the annoying quote thing there is that, we don't know what their intent was. If it was by accident, if it was an error, that's fine. That would be an error. But if they intentionally did that, then we would consider that fraud. So management should put internal controls in place to make sure, and we'll just think accidentally errors right now, that they don't have a misstatement in the assertion. Put an asset down the financial statement that exists when it does not. So I like to think of the internal control as a roof over the financial statements. It's raining misstatements, whether intentionally or by error. It's raining down misstatements, and the financial and the internal controls are preventing those misstatements from hitting the financial statements as we go through during the year to year, conducting transactions. Then what? We'll go ahead and we have a system to accumulate those transactions. We prepare the financial statements. We issue the financial statements, and we're saying to users, and they didn't show us the owners here, but the typical users and the primary users would be owners or potential owners, right? So this really could almost be thought of as our owners. I'm going to go ahead and just write that in. Our owners are really the users that we're concerned about here. And here comes our brain, the auditor, and the auditor is going to come in, obtain evidence. There's that key word again, evidence. And then we're going to apply audit test, and the auditor tests the assertions. You see how they're setting that up, guys? Again, when we do our test, we're auditing the assertions. If you do any audit procedure, and I tell my students this all the time, if you do an audit procedure and you don't know why you're doing it, then you're not doing your job. You need to understand that you're doing an audit procedure to test an assertion. So if I want to see if an asset exists, I'll look at that asset being listed on the financial statements, and I will walk out there and I will look at that piece of equipment. The auditor is applying an audit procedure that will give them direct personal knowledge as to the existence assertion over that asset. Based on that evidence, we will then determine the fairness of the financial statements, and we will issue a report that accompanies the financial statements. And again, that report sits there and provides credibility to the financial statements. Now that absentee owner can look at those financial statements and say, this individual who is licensed by the state has come down and said that these financial statements are fairly stated. Okay, so that is really the thrust of what the auditor is doing with their involvement with those financial. Yeah, I'm trying to circle evidence there, so let's try that again. We have evidence. There we go. We have evidence, and that evidence is going to support the financial statements. Now, when we look at this in the context of audit risk. Audit risk is the risk that the auditor will say that the financial statements are fairly presented. The auditor will come out and say financial statements are fairly presented. Tell the owners that they believe the financial statements are fairly presented. The owners rely on those. They get that credibility from the auditor. And then it turns out that the auditor is wrong. It can happen. We don't want this to happen much, but it can happen. This is our audit risk. Okay? It's possible, because we're going to see we're only going to have reasonable assurance. It is possible. The financial statements that we will say, in our opinion, the financial statements are fairly stated when in fact they are not. We missed some misstatement, whether caused by error or fraud. We don't want this to happen much, but it can happen. We're not infallible. Okay, so this is considered our audit risk. Now, we also will consider this concept of materiality. And materiality says, look, we're not here to find 2-cent errors. We are not here to find an error that won't change your decision about this company. Okay, we are here to find errors, and I keep saying errors. I've said it a couple times, errors. I should say misstatement, because we don't know if it's an accident. It could be intentional, in which in that case it's fraud. We are here to find material misstatements, whether caused by error or fraud. We are not here to find things that will not change your decision. This idea of materiality allows us to be more efficient in the audit. If we had to look for 2-cent errors, we'd be there the rest of our lives. We need to be able to look at things that are going to make a difference in the decision-making process of those absentee owners, those users of the financial statements. And when we think of users, we're thinking investors, creditors, those that are going to be these absentee owners that we need to consider. So 3 very important areas here, and let's go ahead and let's dig into some of these. Again, looking at materiality, okay? And you can see that if information is material, if it could influence this decision maker, okay? And you're going to probably get a little bit tired of me commenting on the pictures. I don't know, my imagination is such that I'm looking at this guy and I'm feeling sorry for him. He looks like he's in trouble when he's going to grab that apple. But anyway, just taking a look, we're talking about what? We're talking about decision makers that could influence the decisions, and I don't like that color. Let's go ahead and they have these yellow, and I'm trying to not use yellow. The decisions that could make, others could make on the basis of the information in the financial statements for the reporting entity. Okay, so what's material? Let me give the example, okay? Let's say that somebody says, if I had known that the financial statements were misstated by $25 million, I would have never bought that stock. So what happens? That $25 million was material to that user. It would have changed their decision. They wouldn't have bought that stock if they had known there was a $25 million misstatement in the financial statements. So when we talk about materiality in Chapter 3, we're going to actually have to come up with a dollar amount that we think is material enough that it could change the decision of our users of the financial statements. Okay, so when we're thinking about materiality as auditors, we're thinking about who might actually use these financial statements. Now, when we talk about materiality, I just gave you a quantitative example, but we also have to consider qualitative aspects of materiality. For example, if I had known that the financial statements were misstated by $25,000, notice the amounts come down tremendously, because of management fraud, I would have never bought the stock. Now it's a qualitative aspect that changed the decision-making process. So the auditors are there to find material misstatement. We don't go in saying, hey, we're super auditors. Anywhere where there may be misstatement, we're going to find it. We look for material misstatement, and we will literally design our audit procedures around those materiality thresholds that we'll talk about more in Chapter 3. So when we come over, and I've already given you some of these terms, we've talked about audit risk. Audit risk is the risk that the auditor will mistakenly give, and we're sort of jumping the gun here a little bit because we start talking about a clean opinion up here. Meanwhile, we haven't described clean opinion to you, and I don't want to do this right now. I want to go ahead and go back to slideshow. So let me see if I can get us back, guys. A little bit of patience for 1 second while I figure out why this is happening to us right now. So let's see if I can get us back to the slide where we were, and hopefully this thing is... Okay, I think we're back. Okay, sorry for that little snafu there. That will probably happen from time to time, so please bear with me while I get us back to business here. Okay, but if you take a look, you can see that we are looking for reasonable assurance. Okay, so when we look at the reasonable assurance, sorry guys, we were talking about audit risk. Okay, and when we talk about audit risk, as we've said, audit risk is the risk that the auditor will unintentionally give a clean opinion. That's where we were. A clean opinion. Okay, a clean opinion is what we call an unmodified opinion. Okay, clean opinion means that I think the financial statements are fairly stated, when in fact there is a material misstatement in the financial statements, and it can happen. We don't want this to happen, but it could happen. That's that idea of audit risk. Now, when we give audit risk, we only provide reasonable assurance. Okay, we provide reasonable assurance that the financial statements are fairly stated. The reason we give reasonable assurance is we don't know. There's few things that can affect a situation where we have given the wrong opinion. We've given a clean opinion when there's been a misstatement. First of all, we don't look at every transaction. We're going to talk about sampling here in a little while. We can't look at every single transaction. So there's a chance that based on a sample of the transactions, we did not believe there was a material misstatement. In fact, if we had looked at every single transaction, we would have found that material misstatement. So we're bound by the realities of sampling. We are bound by the fact that we are human beings. We could, yes, make an error. We thought we didn't have a material misstatement, when in fact there was one sitting right there in front of us. The third aspect, we are looking at our evidence and how it relates to the financial statement. We don't sit there and say that we are smarter than everybody else. We look at evidence, we look at it in the context that someone is slicker than us, and they're going to sit there using yellow here, and they're going to have a misstatement, and they're so slick that they hide that misstatement. We have these different aspects. So we're looking at our evidence as it relates to the assertion. Our audit want evidence about the existence assertion. You're going to have to go from the financial statement and go and find that red that item actually exists. Whether it's reasonable sending confirmations out to the company's customers, your client's customers, or whether it is actually going and looking at a particular asset. Reliability, okay, is to what extent we can actually rely upon the evidence. So how effective is that evidence in helping to see the true state of, and you could say of the financial statements, or you could say for a specific assertion, because we look at evidence as it relates to our assertions, okay? So if we actually go and look at a asset, that is the auditor's direct personal knowledge. That is the most reliable evidence that we can obtain. We could also obtain external evidence. We get support. We get a letter from our client's customer. They call that a confirmation that says that they actually owe money to the client. So we're looking at account receivable. We just got external evidence that supports the existence assertion over accounts receivable. We could get internal evidence, maybe an invoice that we look at. Now that's internal, and it's maybe giving us some evidence as to our rights and obligations assertion that they actually own that. It's internal. It is certainly better than the lowest level of evidence, which is oral evidence, is the least reliable evidence that we could obtain. And if it's oral evidence, we're going to have to combine that with some other form of evidence. Rarely is oral evidence by itself sufficient to provide evidence as to a assertion being tested. Okay, so there really is a hierarchy of evidence, which I just rattled off. Auditor's direct personal knowledge. Then we have our external evidence, our internal evidence, and oral evidence is the least reliable form of evidence, but it can be combined with one of those other types of evidence. But again, we look at the evidence in terms of the reliability of it, and we look at it in terms of the specific assertion being tested. So we line up our evidence with our assertions, and everything we do when it comes to audit procedures go along with those assertions. Now we've talked about sampling, okay, and we use sampling to basically allow us to make our conclusions, and it could be our conclusions about the internal control, but also about amounts included in the financial statements. So this will give you an example. Let's say you're auditing McDonald's, and you've seen the signs, the billions and billions, right? You've seen those signs. Well, look, you can't audit every single transaction that McDonald's has. You're going to obviously want to pull a sample of those transactions and see if that sample allows you to form a conclusion about the particular, again, assertion that you're auditing at that point in time. So if we're talking about French fry revenue, You're not going to audit every time they sold French fries. You're going to pull a sample of transactions for French fry revenue. And I don't know that you would slice it, no pun intended, that granularly where you're just looking at French fry revenue. But again, just the point of all the French fries they sell, right? You're going to take a sample. Now, the problem with sampling, and we're going to learn this in some of our later chapters, is sample that can necessarily not reflect the true state of the population. And if that's the case, that could lead to our having the fact that we give an incorrect opinion. We have audit failure if the sample is not not indicative of the population, and that's one of the factors that could affect our audit risk. Okay, so sampling is something that is very important. We're going to learn more about this, and it basically means that the auditor does not look at every single transaction. We're going to pull sample transactions and look at those and try to form a conclusion based on that. And let me say one more word about sampling here, because a lot of times students see sampling and they see the word statistics, okay? That is not what we're going to be doing here. We are going to be understanding more how the auditor applies certain terminology in the audit to terminology related to sampling to describe the precision to which we are making our decisions. So don't worry, you're going to see that this is going to be a lot easier than your statistics class. We're not going to be crunching a bunch of sampling numbers here, so don't worry about that. Phases of the audit. Client, ranging from client acceptance to issuance of the report. Okay. Now, this is an area, as I mentioned in the introduction, where I do get a little bit concerned, where the book starts to dig in. I feel a little bit more than we should at this stage, but let's go ahead and let's take a look at a couple of these, and then I think you'll see some of these in the homework get a little bit granular, but I think we'll be okay as we start to move probably by chapter 3 and stuff. Some of those things that they're asking, some of the homework questions will be a little bit more clear to you. But let's just take a look. Client acceptance and continuance, very important. What happens if we get involved with a management that lacks integrity? What's going to happen to us? That lack of integrity from management makes our job much more difficult, because we're looking for management to provide us a set of financial statements that should be pretty much, when they're handed to us, free of material misstatement, and then we're going to apply procedures to see that those assertions about those are indeed fairly stated. Well, if management lacks integrity, our job just got a lot more difficult. And so we want to avoid a client where management lacks integrity. This is a huge client acceptance issue. It's probably, one of the most important ones, because if you look at the case of Arthur Andersen, they got involved with Enron. That was obviously a management that lacked integrity, and look what happened. It brought down the whole firm. So client's acceptance, continuance is a very, very important first step of the phase of the audit. We first have to accept that client. So we can see that client acceptance is very important. And by the way, page 18 of your book, starting about page 18, figure 1.4, and going all the way through to page 20, are pretty good pages for you to look at in more detail, where they really start to give you some of the detail around some of these steps here that are listed on this slide. But client acceptance, huge one. One of the things that we do with client acceptance is we have a requirement that the auditor must speak to the predecessor auditor. What the heck is a predecessor auditor? Well, what happened? Let's say last year you audited a client, and then that client changes and I become the auditor in year 2. In that scenario, you would be the predecessor auditor, I would be the successor auditor, but before I could accept that client, in 99.9% of the cases, there's a requirement that the successor, me, talk to the predecessor, you, and ask some very specific questions, and one of them bears on the integrity of management. Again, something that that what I just described to you is a requirement of the standards, something that the auditing standards promulgated by the Auditing Standards Board and the Public Company Accounting Oversight Board. We'll learn more about that in the upcoming chapter here. But the client management integrity, I should say, is a big part of the management acceptance. Now, we'll have preliminary engagement activities. Obviously, the word preliminary is a early step process where we will go through and we will start to make some judgments about materiality, about the internal control. We will start to plan the audit then, how are we going to staff that audit, etc. Oh, important part of client acceptance. Let me go back because I talked about how we're going to staff the audit. Client acceptance is not just looking at the management and saying, is this a management that we should be involved with? It also involves the auditor assessing their ability to properly service the client. So a one-person audit firm cannot audit GM. Too many transactions, too big of operations for that to happen. So we have to have the ability to complete that audit through staffing, through knowledge of the industry. Now look, it's not requirement that you have the knowledge before you accept the client, but you have to honestly assess the firm's ability to acquire the knowledge to be able to complete this audit. And the standards and really the ethical standards of the AICPA are very clear in that it is not okay to get halfway through the audit and then say, oops, I don't have the expertise to complete this, my bad. It is something that you have to take very seriously. Can I successfully complete that audit? So as you do, then you start to plan the audit, and as you go through, you start making decisions about staffing levels, the level of supervisory involvement, etc. We will then consider the internal control. Remember, we look at that internal control as a roof that is going to help prevent or detect misstatement on the financial statements. And if we find that the controls are stronger, then we do not have to do as much procedures over the particular accounts, looking at the assertions in those accounts. If the controls are weaker, then we're going to want to dig more into those various areas where we believe there are weaker controls. So the controls really help the auditor to see the level of work that they're going to have to perform on those different accounts. And if the controls are stronger, the auditor will not do as much work. If the controls are weaker, the auditor will do more work. Then we have some procedures towards the end where we will complete the audit. For example, there has to be direct communication between the client's attorney and the auditor looking for unasserted litigations, claim, and assessments. We're going to get a management representation letter that comes at the very end of the engagement in which the CEO, CFO will sign off that they've given us complete information. If there was fraud, they've told us about it. And then, of course, we will evaluate the results and issue audit report. Issue audit report is our last chapter in which we're going to dig into more detail about the report, but we are going to get into some basic preliminary understandings about the report on some of the next upcoming slides. But we'll really dig into that towards the end. This is the product. The audit report is the product of all of our work. After we've gone through and we've done all this work, our product will be our audit report that, of course, will provide credibility to the financial statements. So let's just actually look at the audit report. And again, the title of the report has the word independent. Okay, remember that independent brain that came in and did the work? We are independent. That means that we can't own any of the stock of the company. Even an immaterial amount, we can't own one share of that stock. If we're not independent. We can't audit a firm in which we have a relationship with a key member of the firm. So we can't be married to the CFO of the company. Okay? When we address the report, it is not addressed to management, it is addressed to the owners of the company, to the stockholders. They are the ones who we are reporting to. Remember, they're the absentee owners. Okay? And so we have an introductory paragraph in the report, a scope paragraph, and an opinion paragraph. And we're going to revise this as we get into Chapter 18, because this is really describing the format of the report for public companies, and there has been some changes to that, and we're going to get more into that in Chapter 18. Okay, so this is a very basic, almost sort of, this is really almost an obsolete discussion, the way they're doing this here. When they talk about an unqualified report, it also is now known as an unmodified report. You can write that in, unmodified. You're going to see in your homework that they keep referring it to an unqualified report in these early chapters. I'm going to expect you to understand the term unmodified. And this 3-paragraph report, I say obsolete, it really is more of a, for just the public companies, it's still in effect. But we're going to have to learn more about the way these reports are structured for the non-public companies as well, because CPA exam does ask about that, so I want you to be aware of that. But for now, just at a high level, understand these 3 paragraphs: introductory, scope, opinion. And in the introductory paragraph, we say that we have audited these financial statements. Scope paragraph describes the scope of the auditor's work. It says that we applied our procedures in accordance with the generally accepted auditing standards. And then the opinion paragraph comes out and says, in our opinion, the financial statements were fairly stated in accordance with generally accepted accounting principles. Now, when we give these reports, they can be, again, unqualified, unmodified, qualified, or adverse. Okay, so when we come over and we start to look at these different types, and if we're talking about what? If we're talking about the unqualified, again, I want you to call that unqualified, unmodified. I'm not going to rewrite unmodified in there, but I just want to put the face here. Now the auditor is happy, right? So if it's unqualified, unmodified, we got a happy auditor. Again, if there's some problem with the financial statements, the auditor has become, and I lost my drawing now, I'm going to have to draw that again. Isn't this wonderful? Okay, the auditor is sad. And then when we get to the adverse opinion, now the auditor has gone from sad to crying. Okay, and it really is a level of materiality that has to do with the auditor's judgment. Okay, and let's just go back to your buddy's suit. Okay, when we deal with the adverse. Let's say your buddy calls you, says, hey, come on over, I want you to see how my outfit looks for my job interview tomorrow. You come over, and he's in a full sweat outfit now. It's not just the shoes, it's the full sweat outfit. You say, well, okay, put on your suit for the interview. This is my suit. I'm going to wear a jogging suit to my interview. You say, no. You will not get that. You cannot wear that outfit. So it's not except for the shoes now. It's the whole outfit, that you've given an adverse opinion on. Well, if you relate that to financial statements, you are basically telling that there are so many errors in these financial statements they cannot be relied upon. Now, I'm saying so many errors. It could be one error that is so huge, that is so big, that you believe the financial statement should not be relied upon. So it's a matter of degree. How bad the auditor, how material the auditor believes the misstatement to be that leads you to the conclusion of either a qualified or adverse opinion. Again, guys, they are going, I feel a little bit deep here, but I think they're setting that up because we'll talk about situation conditions that can lead to qualified adverse opinions later, and we're going to see how the structure of these reports will look when these different things happen in Chapter 18. So do look at this, understand what these different things mean, and then we're going to look at the structure of these reports in much more detail, Chapter 18. Okay, so there are some changes coming to the audit report, and again, they tell us about the changes. They didn't show us the changes on the book slides here, but I've already started to talk about some of those, and so we will get into that more when we get into Chapter 18. So just hang tight on that. We'll get that more in Chapter 18. Okay. Okay, so just taking a look at a couple of the last slides here, we're dealing with what? We're dealing with logical process, okay? And we say that sometimes being a good auditor requires imagination, innovation, and again, I like you to just think about that we're going to be using our imagination in this class to help us visualize some of these procedures and what would be the best procedures under different circumstances. So we're going to see that it's not just mundane following the procedures, it's understanding what is the logic, why are we doing the procedure is an important takeaway as we study auditing. Okay guys, well that's chapter 1. Hopefully this discussion will help you, and what I'm going to do now is quickly talk to you about a couple of the homework questions that I think you might need a little bit of extra help on, and then I'm going to turn you loose to work through those on your own. So we'll be talking about the homework here in a couple seconds.